Welcome to Who's Really the Boss podcast. I'm Rachel Dillon, and along with my husband, Marcus Dillon, we share the joys and challenges of leading a $3 million accounting firm together. From team structure to growth strategies, we share our leadership successes and failures so you can avoid the mistakes we have made and grow a valuable accounting firm. Welcome back to another episode of Who's Really the Boss podcast.
Hey, thanks for having me back.
And we are doing a special welcome for our guest today, Doug Lewis. Welcome.
Thanks for having me, guys. By the way, just before we get too deep into the weeds here, I am curious, who is the boss on this episode? Because,
you don't even have to ask the question, man.
No. Okay.
That's what everyone says. I promise you. I am probably the boss at home, and with the girls at work, I am very happy to not be the boss. So Marcus is definitely the boss when it comes to DBA, Dillon Business Advisors.
I think it's funny because I think Rachel is that meme that you see floating around where someone's crying and they said, when did I get this important at work? And what do I do? And they're trying not to believe that they're important. So even though she says she's not the boss, she's pretty important around here.
That was a really good way of hiding the fact that she is really the boss everywhere.
Exactly.
But that was a good answer. It was a good rehearsed answer. Which
if she wants to elevate me, whatever, I guess I just get hit by the bus first, right? I get pushed out of the way.
I get that though. I understand. That makes sense to me from a distance.
Yeah. Awesome. Well, Rachel, you want to continue the intro for Doug?
Yeah, Doug, will you do a self-intro? Will you tell our listeners, in case they haven't met you yet, a little bit about you?
Yeah, absolutely. I'll try to keep it brief and not a sales pitch. So thanks for having me on. My name is Doug Lewis, Managing Director here with the Visionary Group. For those that aren't familiar with my entity or myself or anything that we do, 100% of our clients are accounting firms coast to coast in the U.S., a little bit of work in Canada, some in Mexico, but we're pretty much U.S. focused. The overwhelming majority of our revenue is really helping firms complete M&A transactions. Now, the M&A world is crazy, which I'm sure we'll touch on a little bit here, especially in the accounting sector. I want to make it clear that our core deal sizes, because people always see these big splashy deals, our core deal size here is really 2 to 3 million on the lower end to about 30, 40 million on the higher end. So that's where we live and breathe in kind of our transaction sizes. And I think it's important to note because so many people have their own thoughts, misconceptions about what the M&A market is, and all the deals are just these monster deals that are happening in the private equity world. So that's my organization as a whole. The remainder of our revenue outside of the M&A world is we help firms figure out how they can remain independent. So we actually act as the chief revenue officer for a lot of accounting firms coast to coast, bringing all these different expertise on the staff that we have here that are much smarter and better looking than me, who actually do a lot of this work. So very deep in the accounting profession. We don't touch any other industries, no law firms, other professional services, anything like that. I have been doing this for about 9 years, to just shade under a decade, maybe 9 and change now. My day-to-day is wildly crazy and different, especially now with the volatility of all this M&A stuff that's happening. So most of my time is really putting out fires that we're in the middle of transactions on and helping my team figure out how to source some transactions for a lot of the clients that we do work with, who mostly fall in the top 300 firms, just from a size perspective, a lot of our clients. So that's kind of in a very, very short-winded way, even though it might not sound like it, and kind of who I am and what I'm doing in the accounting space.
It's good. It's great.
That's really good. Will you share also with us a little bit about who you are outside of the office?
Absolutely. So, we were just talking before we started recording. I'm a newer father, which is, crazy in its own. So I have an 11-month-old at home. My beautiful wife carries the biggest load on that, no question about it. So born and raised in Chicago, spent some time in Milwaukee, Wisconsin, a couple years out in Los Angeles as well. In a previous career, which had nothing to do with the accounting sector or any type of consulting work, spent a lot of time flying around to different professional sports venues across the country. So I had a bit of a 180 from a career perspective in kind of what I was doing to the last 10 years. So I'm a Midwest guy at heart. A lot of people say I have a Chicago accent. I don't hear it. But I hope, from what I can tell, I'm a relatively relatable guy, as down to earth as I possibly can be, which is great from the angle that the camera is, by the way. My head looks really small, but it usually is significantly larger. That's just me in a nutshell. Nothing too crazy, nothing too exciting. I'm just your everyday man.
Awesome. Well, hey, I appreciate you being here. And, Doug, we've known each other for a while, and I respect your opinion and your view of the market because you're actually in these deals, right? And I think we were talking about this a little bit, the visionary group and your role, Bob's role, your whole team actually close deals, both for buyers and sellers of accounting firms. And part of the noise that we see in the market today are people commenting and portraying themselves as deal makers. And it's frustrating for those of us that are navigating M&A and growth and different things like that. But I'm sure it's also frustrating to you and others that actually are a part of deals that actually close.
Yeah, there's a lot of interesting perspectives out there right now. Let's put it that way.
Yeah.
And we're seeing a lot more people pop up with this kind of I'm this M&A scholar academic viewpoint where I dig through all this data and here's exactly how all accounting firm deals need to go down and here's how private equity deals go down. And like you alluded to, a lot of these people who are, portraying themselves as experts in that field, in this sector, aren't necessarily doing any of these transactions. They're talking about it. And what is really interesting to know, especially if you are seeing some of this content out there, these reports or analysis of M&A in the accounting world, the source of where they're coming from is almost more important than the data that you see and the content that you receive, because the overwhelming majority, and I mean well in excess of 90% of M&A transactions in the accounting world, none of the details are ever disclosed publicly. None of the structures, none of the cash components, none of the earnout targets, none of the valuation points, none of it's ever disclosed. So I always question where these people get these data points from and all this fun stuff, especially if they're not doing these transactions themselves, which a lot of them aren't. So, everything you see, everything I say, certainly take with a grain of salt. But, I think it's really important to know the source of where the data is coming from. And so many of these benchmarking, reports that are industry wide are less than accurate, to say the least.
Yeah, I think it's to those of us that know, we find it amusing and we get frustrated, right? And it's I saw one, and I actually had to comment. I couldn't not, and they did a profile of a firm owner in Houston that I actually know, and they didn't even give it half of it right. He's much more successful than what they showed, and I sent it to Matt, and I was like, I just want you to know that this is out there. And he just kind of chuckled as well. So it's fun and it's interesting. And you kind of have to surround yourself with people that to be of character and that actually, work alongside firms and alongside buyers and sellers. So appreciate you being here. I'm sure we're going to get into a lot of the nitty gritty, and I'm going to try to pull out some of that 90% that people never get to hear about. And maybe we can just be general about it, but still leave our listeners a little bit better than we found them. So, Rachel, before we kick off, I know you've got a question you want to ask Doug.
Yeah, Doug, and I prepped you with this ahead of time, so hopefully you had a chance to think about it. But I asked you to think about the best piece of advice you've ever received. Marcus and I always like to ask every guest in case we go sideways and have no idea what we're talking about or deliver anything of value. At least maybe that one piece of advice will help somebody listening. So will you share that now?
Sure. And it's a great piece of advice. I know many people have gotten it, many people have given it over the years, but I have found this to be so helpful in both my professional and personal life. And the advice is essentially at its core, people won't always remember what you said, but they always remember how they felt when they interacted with you. And I think that is really important to remember, not only, again, in both professional and personal lives, but we're talking specifically about the M&A sector. I mean, perception, personalities, all this stuff goes so much further than people think. in pretty much any situation. And, you know, I started thinking back on some of the mentors I've been fortunate enough to have in my professional career. And it's very true. I can almost remember no legitimate advice any of these people have given me. But I remember exactly like, wow, he or she was really impactful and they knew exactly how to approach things and how to make people feel, important and incorporated. So that concept of they don't remember exactly what you say, but they remember how you feel. I think that is just something that it's great advice. I know it's given a lot, but I think it should be given more, honestly.
Yeah, that's great.
I think that's really good. And I think it's really important, as many of us and our listeners are accountants and accounting professionals, that's so important to remember, because a lot of times when clients are coming, their stress level may be high because they don't feel comfortable around money, or they are feeling stressed by an IRS notice or the possibility of that. And so I think that's really important for us as accounting professionals that maybe think like it's just a tax return or it's just a financial statement, and just recognize how money is a hard thing for a lot of people and causes a lot of negative emotion or a lot of stress in those people. So definitely how we treat them and how we make them feel is very important, just as important as whatever product or service we're trying to deliver.
Exactly. I think too many people underestimate just how important the relationship is in the accounting sector, because everyone loves talking about the numbers, firm performance metrics, client calling, client upscaling, billing fees, structures, all this stuff. People forget though, your marquee clients are the ones that you have the best relationships with more often than not. And, that feeds back to, Marcus, your point earlier of a lot of people making noise about the M&A sector right now, not necessarily doing these transactions, looking at it from a very pragmatic view,
Yeah.
and just through that one lens. That's a bit of a dangerous perception, I think, especially when we start talking about M&A transactions.
Yeah. All right. Well, that's a great segue. So before we really get started with some of the nitty gritty and numbers and stuff that I'm going to ask you, how did you and the Visionary Group kind of get to this point? Was it always accounting that was the focus? You said that you traveled and visited a lot of professional stadiums, so would love to hear more about that. But fast forward to where you're at today, what was the journey to get to where you're at today?
Yeah. So the Visionary Group as a whole, we in 2025 just hit our 30-year milestone as an organization, which is exciting. And we've gone through probably 35 different versions of what this company is to get to this point, which is, very normal in a lot of entities. But for the first 10 to 15 years of this company's life, all we did is essentially outsourced marketing for accounting firms. That was it. So, all the web development, social media and stuff, all that fun stuff. And then about 15 years ago, roughly, we had a client come to us say, we're thinking about selling our practice and retiring. This is something you can help out with. And of course, at the time, we were still a growing company in that phase. And we said, yeah, absolutely, we can do that for you. Not knowing the first thing about conducting a merger or an acquisition transaction. So kind of, really took a machete through the jungle on that trip. And we did find a home for them at the time. Still a good transaction for everybody. We didn't make a dime on it because we didn't know at the time how to do that, how to approach it. We were just doing a client service and figuring it out. So that was about 15 years ago was our first transaction in that world. And over the past 15 years, we've continued to evolve, figure out the marketplace, evolve with the marketplace. And now the M&A portion of our business really accounts for north of 70% of our overall firm revenue. So, it's evolved quite a bit like everything else in the world, as well as a lot of our other consulting services. But, the bread and butter that kept the lights on here for the longest time was just acting as the outsourced marketing department for accounting firms coast to coast.
No, that's great. And I think the evolution, the 15-year and the 35 different, versions of Visionary Group, it's heartfelt. I think that's where reinventing yourself, seeing a need, seeing an opportunity and going after it. Love that. Building to where the M&A market is today, was 2024 the highest amount of M&A transactions the Visionary Group was a part of?
So 2024, first off, yes, absolutely, without a doubt.
Yeah.
2024 was industry wide across the accounting profession, absolutely wild. The pure number volume of transactions that were happening, because you got to keep in mind a lot of the transactions that hit, the national kind of news ecosystems, they're the big splashy transactions.
Sure.
A lot of people don't realize how many $500,000 to $5 million transactions take place almost weekly at this point.
Yeah.
That's where the bulk of transactions really take place when you start looking at the size of firms that exist in this country. So 2024 was hands down the largest volume of transactions. And 2025, so we're recording this early March. I don't like dating things too much, but I think it's important to note we are already going to likely double our volume from last year, just based on the projections we have in March of 2025. So yes, it's extremely volatile. The activity is showing no signs of slowing down whatsoever anytime soon.
Yeah, that's good. What are you crediting that to? I know there's a lot of things that I would assume we're crediting that to, but just the volume of transactions increasing to where we're at today. What are the top 3 things that are the reason for the amount of transactions that we're seeing?
So I don't even think we have to go to 3. I think top 2 cover it pretty well. The first of which, I don't think it's a surprise. A lot of people talk about this, but we're starting to see it actually happen and play out in the marketplace. The average baby boomer is in their late 60s. Depends who you ask. Some people say 67, 68. I've heard as low as 65. Whatever. Let's just call it late 60s. And they still own the overwhelming majority of private businesses in the US, which includes accounting firms. Now, a lot of these accounting firms who have aging ownership groups have finally started to age out of the game. So, unfortunately, a lot of them are starting to realize that their internal succession plans either were non-existent this entire time and or have fallen apart in recent years when they try to execute them. So there's a lot of forced activity that we're seeing based on the age of these ownership groups. I think that's the number one culprit of how much activity is happening out there. The second culprit is M&A has become such a vital growth tool for mid and large-sized accounting firms out there. When you look at the inorganic and organic growth methodologies of firms, once a firm reaches a certain revenue size, it's extremely difficult to move the growth needle if you're just focusing on organic growth. The numbers can get staggering on how much new business you have to bring in to move that growth needle. So, it's kind of this weird perfect storm where there's all these aging owners of firms of all sizes, by the way. It's not just small and mid-sized firms. And then we have all these buyers who are starting to aggressively adopt, M&A into their growth strategies. And honestly, a lot of the mid and large size firms are starting to use M&A as their number one growth strategy. So, it's kind of this weird mix of, I think between those 2 points alone is driving the overwhelming majority of this activity.
Yeah, no, that's good. The Accounting Today just released their top 100 fastest growing firms, right? And I was looking at that this week, and I think the top 5, one of them was just an aggregator, right? Somebody that puts firms together and grows, and they grew like 300+%.
Yeah.
And then, so it would be really interesting to see, okay, I get that's total growth, but what is organic growth? What is inorganic growth through acquisition? Do you have any idea what a typical organic growth would be for these firms?
So we're looking at like a top 100 firm, top 300 firm.
Let's say top 300, because top 300 is probably what, 10 million and above?
Yeah, give or take. The bar always moves a little bit, but yeah, you're in the zone roughly. And let's throw Big Four out because that's a completely different ball game altogether. Wow, I would love to say yes. I do have a clear, concise answer on that. I know there are benchmarking surveys that happen and take place that are industry wide. I won't advertise them on your podcast, but I think everyone knows the core 2 or 3 that are out there.
Sure.
Those benchmarking surveys I think are really only as good as garbage in, garbage out, like anything.
Yeah.
And we have many clients who either qualified to be in these top firm brackets that choose to not report and or skew their answers to these because maybe they just didn't understand the questions. They weren't clearly identified or anything like that. So, I think when we look at the data on growth, it's too difficult to tell. But usually it's not uncommon for us to see like top 300 firm just from a purely organic growth standpoint. I'd say between 10 and 20%, it would be a relatively safe average for what we hear from most firms.
Yeah, I would say 10% is probably the minimum, right? Just through price increases and adding a few clients. And I know that you've kind of mentioned the top 300 a few times. We'll just say that that's 10 million and above. 10 million and below, how many firms make up the non-top 300?
Well, sure. This is a fun exercise usually to do in person, like with a group of people in the room, because we get some cool answers. But depending on who you ask, there's no clear answer, but there's roughly 40 to 45,000 total accounting firms in the U.S., just from a pure volume perspective. So, you look at the top 300, that's in a very elite group. Top 500, very elite group. Of the roughly 40 to 45,000 accounting firms that do exist in the U.S., we estimate that there are about 2, maybe 3,000 that are in excess of $1 million in revenue.
Yeah.
So that kind of puts some perspective on how many firms are out there, at that sub $1 million level, which, is really staggering. And that's, again, where so much of this M&A activity is taking place that nobody's really talking about too much, but we're starting to see more and more firms look downstream in their inorganic M&A activity, at these smaller targets, because that's just what's left out there.
Yeah. So let's take that bubble of, I would say 1 million to 10 million, which that makes up what, 1,700 firms, you would say, like
Sure.
given your example, just doing
no
math.
one can prove you wrong.
I'm not good at math, so
Yeah.
we'll see. But yeah, let's take those firms, which that's where we're at. That's where a lot of our friends are at in that space. So what are you seeing? Because obviously less and less firms are becoming available, right? Like I think we talked a while back where the good firms that were eager to do M&A, they were some of the first ones that did a transaction. And now you've got people that are kind of coming to the market, so to speak, but maybe weren't as eager in the beginning. But you also, as mentioned, have firms that are now going downstream, including going below 10 million, which a lot of these original transactions, at least the ones in the news, were all the big boys, all the 10 million plus, the 20, 30, $100 million, right? So what are you seeing given 2024 and maybe even 2025 now, since the market continues to move? What does it look like as far as valuations for some of these firms that do $1 to $10 million in annual revenue?
Yeah, the valuation conversation's fun because if you ask 100 people, you're going to get 100 different responses.
Yeah.
I do love the ones that the consultants or influencers or whoever's out there that say this is how deals are done, and it's black and white. There's one way to do it. Here's what the value of a firm is. I could not disagree more with them. There are too many factors that go into it, and I think the smart acquirers and the smart sellers understand that. But again, now we're fighting misinformation. So when we look at a pure valuation standpoint, the overwhelming majority of acquirers out there in the marketplace are shifting from the multiple of gross revenue down to the multiple of EBITDA, which makes sense because that's how the majority of other businesses trade. I don't know why the accounting profession ever went, that other way. That's maybe a whole separate conversation, which we can revisit at some point. But, the rule of thumb from what I see is that the larger the transaction, the more favorable the valuation will lean. And I know that's kind of a generic workaround answer, but when we work any transaction, we always adjust the valuation back to a multiple of gross, just because that helps everybody understand it from a historical context in the accounting world. Usually, the multiple gross revenue is always going to hover around that 1 time still. Some are significantly higher if it's a niche profitable practice. And some are significantly lower if it's one of those firms that doesn't really have a lot of other options in the marketplace. So, we always kind of tell firms what to expect when you take it to market is you will likely end up somewhere around 1x gross revenue with an adjustment up or down based on these factors. And a lot of that factors into, the age of the ownership group, profitability of the firm, what the service lines are today, billing structures, all that fun stuff. But a safe rule of thumb, 1x gross is still a talking point.
Cool. I think that's good. And my perspective on it is, in the past, CPAs didn't think of their firm as a business, and they just thought of it as like this accumulation of clients. And maybe the valuation that was based on this book of clients, 1x gross, a percentage times gross, that's how they treated their business. They didn't run their business like another industry that actually looks at EBITDA. And so I think it's good that now valuations are shifting to EBITDA focus, because maybe it'll force CPA firm leaders and owners to think about their firm as a business and make hard decisions to improve bottom line, then which increases valuation and their hopefully succession plan. So I think that's part of the shift. And I've been in some rooms with some seasoned CPAs, and yeah, you can tell like they just created themselves a job, essentially, is what they did.
Seasoned. See, that was a good cover. I like that.
Yeah, I'm getting seasoned.
We can't say old anymore, because now we are getting old, and so we have to start finding some better words for that. But Doug, what would you say potential buyers are most focused on, or what gets them most excited about a prospective purchase?
So it depends on who the buyer is, because there's a lot of new buyers entering the marketplace these days. But if I'm looking at like an independent traditional accounting firm who's a buyer in this case, what gets everybody most excited is talent. And when people hear that, they're like, oh, okay, you young partners, right? People who've already made the jump that's great. Young partnership talent is phenomenal to have. But if you have strong managers, that next level, director, manager level people inside your firm, that's going to significantly help valuation and the structure, and kind of creates more favorable terms. If you are a seller in this scenario, so talent is huge. Name of the game. Marcus, you just hit a moment ago. The EBITDA calculation when we start talking about firm valuations, which again is a bit of a, we're covering a lot very quickly here, but the adjusted EBITDA is really what counts. And how firms calculate their own profitability, it varies because for whatever reason, the accounting profession as a whole can't get on the same page about keeping their internal books, which I find the most ironic thing in the world. But again, we don't have to go down that rabbit hole. But I think, from a seller perspective, being able to highlight the talent that you have on staff will set you apart and certainly help you from a negotiation standpoint.
Because accountants get creative with accounting, man. Like we can't just accept the answer.
You guys run an accounting firm. I know you run a very profitable, and the way you do it is like a business. But like you alluded to, the overwhelming majority of accounting firms created jobs for themselves. They didn't run it like a business. So at the end of the year, we drained every penny out, and that was our comp. Yeah. So, when we start looking at EBITDA in these firms, how I'm going to calculate it as a buyer is probably going to be worlds apart than how you would calculate it as a potential seller in this scenario. Yeah. So there's all these different nuances that play into that.
Well, and so let's talk about that, because, we've presented in webinars and on stage about the shift, right? And we discuss EBITDA, and we even poll, collective members about EBITDA and kind of look at things. A question that always gets asked: do you subtract owner compensation from EBITDA? So let's talk a little bit about adjusted EBITDA and how you see that as it relates to how you help firms navigate these conversations about EBITDA, because I've heard the term scrape, and I've heard the term, if the buyer is selling on the other side of the transaction, or what the opportunity cost to replace that buyer owner or that seller owner is. So let's talk a little bit about compensation, partner compensation, as it relates to EBITDA.
Sure. you kind of nailed it on the head. Do we take partner comp out of that equation? So the way that my organization looks at all these transactions, regardless of size or anything like that, when we look at EBITDA, the true profitability in a firm, we look at it before any single owner in that company takes home a dime. That's the starting point.
Yep.
Because post-transaction, you're still going to have to pay, salaries during a transition period, or, if it's going to be a longer term situation, more of a merger. So you then have to add back the salary. So that'll bring it down a little bit. But you're sitting there as a potential seller going, whoa, no, that's my profitability. But you're also taking it home. So that's just one component of the whole thing. We've seen some very aggressive ways to grind down EBITDA in transactions from both buyers and sellers. And a lot of it really depends on who the buyer is. Because you mentioned, things like the scrape, because private equity is a big buzzword right now in the accounting profession. There's so many different ways to calculate this thing, but ultimately the best way to equalize, profitability as a starting point for most firms is to look at that bottom line before any single person who owns a piece of that business takes home a single dime.
Yeah.
And then from there, it can go so many different ways in terms of what's added back.
Yeah. And we've kind of taught that as well. Like, it's always good to know what the business provides to you and your family. So like all the discretionary expenses, all those salaries, like if you were to shut the business down today, how much would you have to go earn as a salary to replace what this brings to your table on a daily basis? Now, and then you kind of similar to how Visionary Group thinks about it. And then you think about, okay, well, who's going to do this work after this transaction occurs? And that's when you have the add back or the replacement of the partner owner that has to be done at market value. And I think you also mentioned the word scrape, and I mentioned it as well. And scrape, my definition of that is just the buyer needing a return on investment, and they scrape that out of profit. Is that a good way
I
to
think
about
that's spot on. It's
Yeah.
if I'm acquiring an asset, how much am I going to make off that asset?
Correct.
Guaranteed.
Yeah.
That's essentially the concept behind it. And it's, again, there's so many nuances to get to these, adjust the EBITDA number, all this fun stuff. But you're definitely, you're in the right ballpark with how most people are looking at this thing.
Well, and it's the opportunity cost, right? So if the scrape on a transaction's 10%, 20%, you have to evaluate this business purchase up against anything else in the market, including just going and sitting that cash in an interest-bearing account. Like, why would any new owner buy this business and all the risks that come along with, the liability that comes along with, to only receive 5% return on investment? No one's taken that deal, right?
Because it's a great business.
That's what the sellers say, right?
The legacy, the name means everything. You get what I've built.
Yeah, you get all these great clients that come in and sit down with me and show me their W-2s every year, right? So
the minute people go down the sentimental rabbit hole, things usually go pretty south in these transactions.
Yeah.
Rule of thumb. You mentioned SDE, or seller discretionary earnings. That's becoming a little more popular way to look at profitability inside the firm as well, because accounting firms, most accounting firms, by the way, are they're making more money than they ever have before. Just in the economic climate we've been in the past couple of years. So a lot of people are hesitant to look at it if you're a seller, from that perspective of going, well, I can keep going one more year. If I just keep doing this for 2 more years, if I could just keep pulling this out. And ultimately, a lot of people are taking that approach to their succession and or transition, and realizing that they just waited a little too long to take the thing to market because they lost all their value. Yeah. Because so much of it really is lying in the relationships you have with those clients and referral sources and all that. So if you're not around to help transition those or grow that book or, make things happen, buyers are smart. Most buyers are smart.
Yeah, I think we've talked about this too. Like, there's going to be some good deals that come out of this season, and then there's going to be some bad deals that come out of this season, right? These buyers, and I would love to spend a little bit of time on who the buyers are right now. You mentioned private equity. You mentioned, I think, other new buyers coming into the market. So let's spend a little bit of time and just discuss who the buyers actually are right now.
Sure. It's relatively straightforward. It's changing a little bit. There's kind of new players in the game quite often these days, but it's pretty simple. We have the independent accounting firms who are continuing to acquire other practices. Ones that independent, by the way, I'll define that as just haven't taken on private equity funding or anything like that. They're 100% owned still independently, and continuing to roll up firms themselves. So that market's always going to be there. It's never going to go away.
Yeah.
We look at private equity now, which I don't like just classifying this as private equity. I look at it as outside investors. So private equity is an option. They are an outside investor that can inject cash into a firm, acquire the whole thing, roll it up. There's a lot of really smart people doing that in the accounting sector right now. But when I look at outside investors, it's private equity firms. I see a lot of outsourcing companies now who are interested in acquiring US-based accounting firms, other technology entities who are in the accounting sector who are interested in acquiring accounting firms. And then, this isn't a new concept, but it's becoming a little more commonplace in these discussions. Wealth managers or registered investment advisors who are interested in acquiring accounting firms. So those are kind of the core players right now. And now we're starting to see this new breed of these larger or mid-sized accounting firms who have taken on either partial or majority private equity investment. So it's kind of these hybrid, half owned by private equity firm, half independent, legacy partner firms who are starting to acquire as well. So, those are kind of the core players in the market, but I've gotten some really one-off crazy, calls or inquiries from people who think they want to be acquirers in the marketplace that have nothing to do with the accounting profession whatsoever. So, it's fun, but it's changing rapidly.
Yeah. All right, let's start with your first buyer, which is your independent firm just looking to grow and do more, right? Like increase the base. Is that still equity swap, right? The unfunded chain letter or whatever somebody else calls it, where it's like no cash exchanges hands at closing, and we're just going to roll you in. We're going to give you some stock in our entity, and we're just going to keep doing what we're already doing. Is that how those deals are still going?
Yeah, so I mean, we look at those type of transactions. It's either it's an acquisition or a merger or kind of these hybrid things. And when we go to full acquisition, it's just all stock is going to be bought out, and it's going to be paid out some version of cash up front. Some timeline on the earnout. Pretty standard stuff based on collections. That's kind of the historic way people have done these transactions. When we look at more of a merger these days, where no cash is going to be exchanged and it's just straight equity swap, essentially, like you alluded to.
Yeah.
No cash down at closing. I'm going to roll into, if the two of you are acquiring me, I'm going to roll into your deferred compensation program, whatever that looks like. And then I'm going to be with you for the long-term growth. And then there's these hybrid transactions where, let's just say it's a two-partner firm. Let's go small to make it easy. A two-partner firm. We have one partner who is 65, another one who's 45. Well, a 65-year-old, day one, is likely going to sell all their equity in the transaction. And there'll still be an earn-out period and stuff like that where you can spread it out. But the 45-year-old is likely going to roll all of his or her equity, into the new entity. So it's not really an acquisition. It's not really a merger. It's kind of this hybrid in between. That's what most transactions really look like, from the independent accounting firm perspective.
And the firms that have taken outside investment, whether it's private equity, family office, something else, 60% of them are owned, or 60% of their base is owned by somebody that wasn't originally there. And I would assume what I've heard is that cash does change hands at those acquisitions or those mergers, correct? Kind of in line with how the firm originally was structured whenever they accepted that investment, correct?
Yeah, I think that's a safe rule of thumb. Like, that's the most common scenario that plays out. But, I've been a part of hundreds of these things over the years, and I've yet to see two transactions that were ever structured in the exact same format.
Yeah.
But I would say yes. In the last, maybe 3 to 5 years, the cash component in the majority of transactions, wherever they're going into, have started to uptick a little bit. Certainly.
Yeah. Awesome.
All right, you gave us one thing. I like to be real really practical for myself, but for others as well, as far as what can they do right now. So you mentioned like developing our teams, developing our talent, and making sure there are people who are empowered to do things besides just the owner within the team, so that there's someone to kind of take that on if that firm is acquired. What other things will continue to increase the value of a firm? Like, what are there specific KPIs or specific things that firms can do? Let's say if they're getting ready to sell in 5 years or 3 years, what is bringing more value to a firm?
That's a good question because it's so different based on the level of firm, right? Like really small firms are going to have a very different roadmap to increase or maximize their, their value if and when they take it to market, other than a mid or large size firm. I would say besides that kind of talent development component, which is still key and paramount in so much of this, really aggressively, I'll say, reviewing your fee structures is just, it's huge. I mean, that is what it is. And we're making the assumptions that, they're already relatively up to date from a technological, backbone and all that fun stuff. They're not sitting there doing paper returns, which I still see it. I see firms that do paper returns still. They're not in the cloud, all this fun stuff. Assuming those are met, I think really aggressively reviewing your fee structure and who your core clients are is massive, because that all funnels down to that profitability, that EBITDA number, if and when you look to transact. And I know it sounds so simple, but we see so many firms they're not setting fee minimums. They're not continuously culling or upscaling the client base. And it can damage a firm's value when they take it to market if they've built a firm that just got bigger on the same clients, without ever upscaling the fee structure or the clientele or all that fun stuff. So that's one, is aggressively reviewing your pricing strategies, to say the least, because I've yet to really see a firm that is priced themselves out of any market, which is shocking. That's one. Another one, of course, is reviewing, and I'm not a big proponent of saying small and mid-sized firms should do this if they can't figure out how to effectively do it, but there's that big buzzword phrase, the shift from compliance to advisory. Let's focus less on the traditional tax, audit, accounting services that, we're built on, and focus more on these advisory consulting services, which generally do have higher profitability margins. I'm a big proponent of that, but I think if a firm is a little late in the game to really jumpstart an advisory department or increase their advisory revenue, what they should do is be able to clearly state and identify the advisory revenue opportunities that exist inside their base to a potential buyer. Yeah. Know exactly, what cards you're holding to say, hey, I see that you have this department already. I have all these clients that are asking for this need. This is perfect for us. So, I'd say those are kind of the two big pieces of advice they give to people when they say, I'm on a 3-year, I'm on a 5-year window. What should I do?
Yeah, that's good.
Those are good. And we just went through an acquisition, and those were all things that we were like, those were like top 3 things that we were looking at, in addition to like technology, software being kind of an easy assimilation of those clients into what we do. And then values, of course, is really big for us personally, because we still work in our firm. And so that's really important that team members, the old owner, and the clients all kind of align with values across the board. So, yeah.
Well, maybe another way to answer that too is how firms can prepare themselves is join the collective.
Those are all things that we are working on. Yeah, that all of the members are working on together and continuing to improve, and just the different ways is, since you just threw it out there, I'll just say like how valuable it is to see different firms from different markets and different revenue sizes, team sizes, service offerings, how they're accomplishing these same things, how they're improving in these same areas. It's not, as we've talked about on this podcast already, a lot today, it's not a one size or one answer or one way. It's not a here's do these 5 things and then you fit this criteria for this buyer. So, yeah, I think it's really helpful to learn from peers and just be able to see what they're doing and what's working and what's not.
You brought up a really great point there, like a checklist or, I know they're out there. I know they exist. Listen, if I wrote a book today on how to conduct an M&A transaction in the accounting profession, by the time you read it, it would be so outdated that all that information would be useless. So keep that in mind. If you're listening and you're trying to figure out, hey, trying to figure out what the best path forward, is for my practice today. Should I look at an acquisition? Should I look at being an acquirer? All this fun stuff. If you go buy a book or a checklist or whatever, or here's the one size fits all way to do things, it could work for you. I don't know, maybe. But if I'm going to Vegas and gambling on that being a very effective method to do things, I would rethink that.
Yeah. I don't think you have to give yourself so much grief, because I think the core principles will continue to win out. There's a story that from long ago, and it's two executives at Intel, and they're facing some heartache in their business, and they have to make a change. And they decide, they ask the question of what's the next CEO going to do once we're fired? And then what's standing in our way from doing that today? And I think that's where a lot of firms should be taking that same advice, which is great, just perspective. What's that next owner going to do with my firm? And you hit it right on the head. It's price increases, evaluating pricing, evaluating, are these clients even valuable, right? So like probably they've been caring for a section of clients that just don't have value in the market. And they create stress, they create hurdles for growth, good growth. And so they haven't made hard decisions on those clients. Maybe there's some hard decisions on team. Are these team members really what that next firm, or even we're reinventing ourselves and we are that next firm? Like, do we need to make a hard decision on the team, or even expenses, technology being a big part of them, right? So I know a lot of firms, you talked about paper tax returns. There's still a lot of firms that operate with servers in the closet.
Yeah. On site. Yeah.
On-site servers. And you just think about like power outages, hurricanes, tornadoes,
just security in general, data security.
Happens.
I mean, there's liability insurance, all this crazy stuff comes into play. And you both now have mentioned this in kind of different ways that, Rachel, I think you actually said the 80-20 rule at one point. Either that you said that, or I, completely just envisioned that in my head.
Yeah.
When you look at like clients inside firms and how to value things and all this stuff, this isn't a plug, but I think it's important to say where this comes from. So, my organization, the M&A stuff aside, we do these market value accelerators for firms where it's a deep dive into we interview all the partners one-on-one and do all this crazy stuff from a growth perspective, but we analyze their client base, from 50 different directions as if we were going to acquire them, right, for somebody else. And that 80-20 rule, where 80% of a firm's revenue comes from 20% of clients, it's a pretty standard business, concept, right? It's not new, but it's not uncommon for us to see more of like a 90-10, 95-5 rule inside accounting firms, again, of all sizes. And, smart buyers, they're looking at this too, going, okay, 10% of your clients are just not even going to come close to what we need here. Really, where are those relationships happening? And, firms are taking themselves to market. So a really smart buyer asked this, because Rachel, you kind of asked, what firms can do to prepare themselves. Really smart buyer asked a firm that we're helping take to market. They went, what can you tell me about your top 10 clients? What are their goals? And the seller did not have a good answer. Seller number one could only come up with about 5 or 6 of them off the top of their head without looking at it on who their top clients were, and realized they knew nothing about what their clients were actually trying to accomplish. They know nothing about their goals. It was a 1 or 2 touch a year type of client that just happened to be a large client. So that's another thing, circling back to that question, is when you're looking at the client base, where's the revenue coming from? What do you actually know about your marquee clients? And more importantly, why are you wasting so much time on these clients that just are not profitable inside the firm?
So many of accountants that we have met over the years, and maybe us at one time included, when we had 2,400 tax clients, we were spending a lot of time, and we were spending a lot of time with very low revenue clients, like multiple touch points on these that spent the least amount with our firm, and it didn't make any sense. And as soon as we looked at that, we were like, what are we doing? We don't even need to spend any time, necessarily on this type of work, especially if we're not trying to grow that type of work. So it's important to look at a client list that way if people are not, right? If you've never looked at it that way or never thought about it that way, you will recognize being able to prioritize things within your firm and within your day become much clearer, much easier when you can recognize where the value is actually coming from within your firm.
Yeah. And even, the 80-20, I mean, it holds true in so many things, man. And so we just acquired this firm in St. Louis, and that 80-20 held. And I presented that to the seller, and I'm like, hey, these top 20, that's who we need to focus on. And he never looked at his firm in that way. And even now on the other side and going through assimilation and kind of getting clients familiar with us, those are our focus. And it even came up today, or not today, but this week earlier. You mentioned putting out a lot of fires earlier. And right now on the other side of a firm acquisition, you have to get your hands around, like, what's the work? What's really going out? What's the cadence? Is it caught up? Does there need to be a project? And, every day there's something that presents itself right now. And I was talking to the seller because he's still on a contract, and he was saying this one-time 1041 trust return, we need to do it. It's a one and done. People are going to be waiting for the K1s. I'm like, do we need to prioritize that over those top 20 clients for a one and done $5,000 trust return? And, once it left my mouth, I'm like, I know the answer. Let's see if he knows the answer, right? He's like, yeah, probably not. I'm like, all right, so it can wait till closer to the deadline, but it's just that perspective. And I think your comment was even convicting to some of us. It's like, what are the goals of your top 10, top 20% of your clients? Because they're making up the majority of your revenue. And then they're going to be the ones that you have to, not convince, but make sure that they're good with that succession event, especially if any part of it is based on retention or any type of earnout. So you better have a great relationship going into that transaction with those clients that make up so much of your business.
Exactly. Yeah. If you're the seller that is defending, part of that buyout and revenue stream. It's, by the way, I can't take credit for that. What do you really know about your top 10? I stole that from somebody who was much smarter than me a couple of years ago.
Hey.
Now I just use it regularly, but I won't say who it is, because
you give credit one time, and then after that it becomes yours,
yeah,
right?
Then people don't pick up the phone and call me. I need them to call me, not them. That's all I do. I'm really fortunate enough, in my line of work and the people I work with, that all I have to do is just listen to people that are smarter than me, it's not a high bar. I understand that. And just take what they do and replicate that for other people. And that's a really fun thing I get to do, is talk to people that just know exactly what they're doing.
Yeah.
Can I ask you one more question before we start to wrap up here?
Of course.
Biggest misconceptions. I'm going to go on the seller side. So firms that are wanting to sell, that contact you, biggest misconceptions when they come to you, and let's say firm size 3 million and below, because I think that looking at the numbers, that's a lot of us out there. So 3 million and below, what are some big misconceptions that they kind of maybe get disappointed or are surprised by once they talk with you?
I think one of the core ones, which speaks volumes, is, well, I had a friend or I had a colleague who got this deal. I expect my firm to be worth this because I saw someone else get this. I mean, your firms might not be the same. They're likely not. Again, I've never quite seen two deals that were structured in the identical way. So when you hear, oh, this firm got a multiple of this, or private equity wants this in a firm, yeah, they do, but they want one in a firm that's 20 times your size. You know what I mean? So like your transaction is going to look very different than, a 30, 40, $50 million firm transaction. And I think that's fighting some misinformation out there in the marketplace, because people only see, again, just the tip of the iceberg of all these transactions and structures. So having reasonable expectations on your firm, that's one of the biggest misconceptions I think a lot of people are surprised to see if and when they try to take their firm to market. So that's number one. Number two, I think, is your timeline. There are a lot of aging owners out there right now who think that when I'm ready to hang it up, I can just list the thing, sell it, and walk away. And those type of transactions where there is not a relatively extended transition period, post deal, those are becoming less and less commonplace in the market. So giving yourself enough runway to successfully find the right buyer or merger partner for your firm, and then having a good wind down transition period post transaction, having planning for that ahead of time before you take your firm to market, I think those are kind of the two that come to mind as the most common things we see that either kill deals or force some of these owners into transactions that are less than ideal for themselves.
All right, I guess this is my last question. Seems like we're year 3 or year 4 into this, right? Into this new cycle of M&A for accounting. Are you more hopeful on the future, or is it really time to evaluate, is this market, is this boom, if you will, coming to an end sooner rather than later?
So I think, and correct me if I'm wrong, the question is is the window closing?
Correct.
For all these transactions. I get that a ton. And this just comes into pure speculation at this point. Number one, there's always going to be transactions to be had. Valuation, cash components, earnouts, some of the players will disappear. That's expected. There will always be M&A activity in the accounting profession. It's just never going to go away. I think, when we look at some of these more lucrative transactions that are making splashes right now, I think that the window is going to remain open for some time still. Especially when we start looking at some of these more strategic acquirers like private equity or these family office groups or registered investment advisors. A lot of them are so new into this game right now, and a lot of them are digging their heels in for a long-term play. So again, that doesn't necessarily mean that 12 months, 24 months from now, we're going to see the exact same valuation and deal structures, but I think the activity is going to remain relatively steady and continue to increase in the short term here.
Well, hopefully, if anything, it kind of creates more of a template, because as you mentioned, like everyone is a different deal. And, hopefully, because we saw this in dental, we saw it in vet, we saw it in other professional services.
Oh, you missed the third one. You missed HVAC.
Okay. Well, all those, right? Now you can kind of know what to expect whenever you go into these, and kind of what valuation, earnouts, all that good stuff are. And there's a market that you can compare. We just aren't there for accounting yet. Every deal is a little bit different. So that's my hope, is that it gets a little bit easier to navigate. Obviously, you want advocates in your corner to help you boost and navigate this with you. So I think, you and your team do a great job at that. My hope is just that, some of the, like you said, 15x multiple, they're going to give me 15x on my EBITDA. Like, that's what I heard in the news. Like,
what? You probably could get that. If I grind that number down low enough, I could give you 50 times.
Yeah.
I mean, and that's why it's just, there's, what you hear and what you see, what you read, just take it all with a grain of salt. But like, that's a great point to prove there, is just because you're interpreting a deal happened this way doesn't necessarily mean that's how it went down.
No, that's great.
Back to your kind of initial question is, I am very bullish on the accounting profession. I think, with all of this activity happening, there is a huge market for the small and mid-sized accounting firms to really just expedite their growth inside the next 5 years with all of this stuff happening, especially as firms will be able to actually leverage a lot of the technological advances that have happened, from an operational standpoint. The scale and the rate at which small and mid-sized firms will be able to grow and compete with larger firms, I think we're going to see that gap, close here pretty significantly.
That's awesome.
All right, Doug, thank you so much. Thank you for sharing everything that you've seen and experienced with us, with our listeners. I think the one thing that I am leaving with from our conversation for sure is that these recommendations and the things that we talked about is not just for an outside buyer. We need to be doing these things as well if we're hoping one day that one of our current team members or a future team member is going to want to buy or continue the legacy of our current firms. We need to make them attractive to the people who are actually working in them as well. So not waiting to do this until we're ready to say, walk out the door or, go sit on the beach or whatever it is what we're planning to do in retirement, but really starting now so that these are attractive to not just outside people who don't know what's really happening inside, but attractive to the people who are, giving their time and effort every day. So.
No, you nailed it on the head. I'll leave it with this because we've gone probably longer than we should, which is okay. This has actually been pretty fun. Every single firm transacts. Now, there's really only 3 transactions out there. Number one is you're gonna either sell or merge the thing, so an external option. Number 2 is you're gonna pull off the internal succession, and number 3 is you're gonna close your doors. That's it. And a lot of firm owners struggle to realize that eventually they're going to transact one of those 3 routes. So at all times, building your firm value to maximize whatever route you take at the end, that's the best way to approach growth inside your firm.
I love that. Well, thank you so much for being here, Marcus. Thanks for helping lead. And I will see you guys on the next.
Thanks for having me, guys. Take care.
Thanks for listening to this episode. If you enjoyed the conversation and want to learn more, be sure to visit collective.cpa. You can schedule a meeting directly with me, Rachel, by clicking on the Contact Us page. Be sure to subscribe, like, and share so you don't miss any future episodes. We look forward to connecting with you soon.